Hello and welcome to another round of monthly macro and market wrap-up. Soft landing has become the dominant market narrative. Recession risks are getting priced out from risk assets, that is, apart from in commodities. Three reasons to explain this. First, US still has expansionary fiscal policy, which somewhat offsets the monetary tightness. Second, unique US business balance sheet structure in recent times that benefited from higher short-term interest rates and led to a slower moderation in earnings growth. Third, tight labor market which allowed a healthy wage growth. In fact, since May 2023, as inflation has cooled off, real wage growth has turned positive, thereby supporting the consumption demand. Over time, we should see the real drag from monetary tightening. Credit standards are getting tighter, defaults are rising. After a brief positivity, housing market sentiments have neutralized again. Outlook for both consumption and investment demand is weak. Jackson Hole Symposium underscored the possibility of more rate hikes and puts an already elevated equity valuations under pressure. US S&P gave up some of its gains in August. China worries intensified last month. The core problem is a severe property sector contraction that is slowing economic growth and generating stress in the pockets of the financial sector, while policymakers face ideological and technical constraints to providing more muscular policy support. One such constraint is a wafer-thin bank margins, which limit the scope of further monetary easing to boost growth. That said, regulators have largely separated such troubled shadow banking operations from the core financial system, which is dominated by commercial banks. Thus, while growth is still under trouble, any Lehman-like financial contagion can be avoided. While equities are weak in China and renminbi has depreciated, they do not portend deep troubles as yet. Indian Nifty gave up some gains in line with the global trends, but small and mid caps still moved up during the month and FIIs were still a net buyers. We had Q1 FY24 GDP at 7.8%, then earnings outcome which were modestly better than expected. Whether we look at the GDP data or various high-frequency indicators or earnings outcome and commentary, following aspects stand out on Indian growth. Exports have weakened and the outlook is cautious. Demand from Europe is weaker than the US and Chinese exports are once again up in competition. Government capex has jumped significantly as government front-loads capex ahead of election. This has led to robust order inflow for construction companies, especially in railways, renewables and defense. Real estate launches are rising as inventory is low, demand pipelines seem to be healthy and industry has seen a consolidation. Consequently, cement and various other building material companies are also positive. Consumption demand both on the rural and urban side is weak. Ideally, with construction and capex picking up in India, its second-order effects should also lead to job creation and consumption demand to improve in years to come. But you know what? Despite all this, when we translate into numbers, all this still does not translate into any material earnings upgrade. Ever-growing Chinese problems, more rate hike in the US, and Japan's recent tweaks to yield curve control suggest that the global economy is on a fragile footing. While India stays better placed, we continue to think that the diversification across assets and diversification across styles and sectors within the equity portfolio should stay central to the portfolio construction in this environment. In fact, what do we mean when we say that we are cautious on equity? We don't mean to stay away from equities, but do a better due diligence in stock selection, as top-down factors are a challenge to equity market returns. Coming to the fixed income market, the yield on 10-year US Treasuries has risen by a chunky 55 basis point over the past month to reach 4.3% by mid-August. It is now closer to 410 levels. US yields have risen more significantly than other major markets, implying US-based drivers are at play. Potential candidates include a better than anticipated growth, sharp increase in US Treasury bond supply, and upward pricing of potential rate hikes in the country. All told, near-term fixed income outlook in the US is more of a neutral. Coming to India, yields have broadly been range-bound when compared to the US. Month to date, 10-year was flat in India and has risen just 20 basis points from May's lows. In the August policy, RBI kept repo rate unchanged but focused on liquidity. It announced a temporary incremental CRR to suck out excess liquidity which has arisen due to discontinuation of 2000 rupees note. The objective was to align liquidity conditions with the stance and lift up overnight rates closer to repo rates. The transmission of the same to other segments of the curve may not be similar, with incremental supply and macro data and positioning likely to influence the same. As the minutes of the meeting highlighted, there is a subtle indication that RBI may perhaps look through the few months of elevated inflation. Hence, we will have to watch the efficacy of government supply-side measures to rein in food inflation and, in general, overall inflation in India. All the members sort of acknowledge that RBI can do very little to pull down first-round effects of supply-side shocks to food prices. However, if they start feeding into inflation expectations, then it could be a problem. Food inflation is now a problem with many other Asian economies, which are pushing out the hopes of rate cuts. Coming to currency, Indian rupee briefly depreciated past 83 levels but then dialed back by month end. Weaker Chinese currency has meddled with our thesis on rupee appreciation. If Chinese currency is weak, that further helps them to export cheaper products and hurts our local manufacturers. Under such a situation, there could be a small policy bias to keep currency weak. As such, we expect rupee to trade in a narrow band for the remainder of the year. In the absence of a major near-term positive trigger to fixed income, we stay put on our cautious duration stance. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.